Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the Note Closure Show. As always, Scott Carson, jacked up to be here with you today. And on today's episode, and this is probably going to be a double feature, not only on Note Night in America, but also on the Note Closure Show podcast, because I know we have subscribers to both. But we're going to be diving in and breaking down this list of 72 first liens. They're called legacy liens because they've been around for a little while, nothing brand new. And it's a mixed bag of notes. And I get this from one of my sources. One of my hedge fund sources sends me lists on a regular basis, and I can cherry pick from this, or I can buy the whole portfolio. And I wanted to go through it because it is a mixed bag of performing and non-performing first liens. And it kind of breaks down. I mean, it's a tape of stuff all across the United States. You've got stuff, and if you're listening to this, you may want to watch the video in the link below. But we've mapped it with batch geo by the performing stuff and the non-performing stuff. And you've got stuff all across the country. And how the 72 breaks down is 29 non-performing notes and 43 performing, okay? And like you say, you got some stuff in Texas. You got a couple performing notes out in California, one in Oregon. You got stuff up in the Midwest, New York, a couple in Florida. It's a mixed bag of stuff across the country. And so I thought, since you guys already love it when I break down these tapes, I thought I would go through and share with you how to make an offering on the full tape if you wanted to, or also how to break it down, because it really is two different tapes, and you've got to adjust your price differently, whether it's a performing note or it's a non-performing note. And it's not very difficult to do. 72 first liens, we've bought plenty of portfolios that were greater than 72 first lien. Now you could also do a carve out. I've already made an offer, I think, on about 15 of the non-performers. And if it comes back available, I'll probably make some more offers on some stuff. There is some low balance of the non-performing stuff. Some of the performers have higher balance stuff. So it's a different aspect of it. But I thought it'd be valuable because we've got a coaching student who's got some deep pockets and they're looking for a tape like this. So I thought I would record it on their behalf, kind of talk through the deal, and kind of come up with an offering basis and then go from there so that you guys can learn and peek over my shoulders while I break this down. All right. So let's dive into the spreadsheet. Let's pull it up. Here we go. 72 legacy first. You can see the map all across. So it's kind of small here. So let me go ahead and make this a little bit bigger for everybody, so it's not hard for everything. So basically what I did, the tape came to me. All right. And basically it was this red and black, the red being non-performing, the black being performing. Okay. And you have the loan number, the address of the property, the street address, the city, state, zip. Originally, the fund just sent out a sanitized lip where there was no addresses. I went back and asked for them, and they provided to me, knowing that I'm a legitimate buyer. Okay. But you've got the zip code, original balance, the current balance. If there's a deferred balance on that, basically means if it's been pushed to the back. Now, it had zero deferred balance. A lot of these numbers that were in here were my actual offers. Okay. So let me go ahead and just delete those off. Clear. There we go, deferred. Because it was just a vacant thing. You got the appraisal, BPO or AVM number, the first paid date on these, and you can see these range anywhere from 2021 all the way back to 1995. So some have been around for a while. You've got the first paid dates, and then you've got the paid through date, and then the next pay dates. And the next pay dates, basically, some are relatively current. They're new. They're due for January of this year, or some are going back to 2021. So it's still within that aspect of things like, hey, 4 or 5 years. I like if they're non-performing, because then you can basically make some money on that stuff. They give you the maturity dates. These are all fixed rates. There's no ARM index, ARM margin, first ARM reset day. Now the thing is, I like tapes where it's got the stuff in it because I know it's a direct download from the lender's servicing information. Okay. Delinquent change cap, it's all direct from them. Okay. Loan status, you can see how many days behind they are in red. If it's flag as in delinquent, it's flag, yes, true or false. BK status, foreclosure status. So none of these are in foreclosure right now. And then you see this was all pulled as of like March 13th. So it's relatively new. It's March 20th right now. So it's basically, this information was pulled a week ago. Bids were due yesterday and today, and we got those bids in. So what I'm going to do first is it's got enough information now. It doesn't give me the P&I payments. All right. It does not give me that. Wait a second. If I go to the raw data, I bet it does. Yeah. So here's the other raw data. Okay. This is better. Sorry, guys. That's kind of the basic information. Okay. So a single family, these are all single family homes, first liens, property value, the LTV, the combined loan to value, uh, the purchase UPB, what's left of the loan. Okay. Hello, this is Scott. Yes, hello. Yeah, I'm not interested. All right, then you've also got the original loan amounts. You've got the loan term. You can see these are 20-year to 30-year. You got even a 15-year in there. I don't see any. Oh, I see something that's been modified. So it says 480 down at the bottom down there. Okay. Emerson Machine FICO scores, the P&I payment, the first pay dates, the maturity dates, all that good stuff. Current UPB, last payment received. All right, so it's got two tabs on here. One is basically most of the data, and the other stuff is the raw granular data, which is what we have in here already. Okay, so I'm actually, let's see, do we have values? Yes. Do we have current UPBs on this tape? Yes. I'm making, give me 1 second here. These are all first lien. I want to make sure P&I payments is important. Maturity dates, due dates, current UPB. Yep. So we have that. Now, most of these, what's missing on here, oh, we have the property values. Okay, good. And like this is, if this was a tape of second liens, there would be an amount for the senior amount, but we don't have, these are all first liens. Okay. So we are going to go off of this tab, the raw data, because it gives us more granular information. All right. And what we can do is we can get rid of some stuff. We'll leave the loan number, the state, city, state, zip on there, obviously. They're all single family homes. Make sure and filter this so we can see this stuff. All right. They're all one single family. So we're going to get rid of a couple tabs. We're going to get rid of the class because they're all single family, all first lien. So we don't need to have those columns in there. There's no senior amount because these are all first liens. We're going to delete the senior amount. Purchase UPB, original loan amount, loan term. They're all, oh, there is one adjustable in here, I think. And this is, we'll leave that in there. You got FICO scores. We don't really care about because we're in the first lien position. First paid date, last payment received. Okay, so now, where's our delinquent status here? Warehouse line days past due. Okay, so what we're going to do is go back here and we're going to sort it between the performing and the non-performing. That's what we need so we can split these up into two tapes. Now, let's just do the assumption. Now, while we can cherry pick this, let's talk as if the seller wants us to buy the full thing. Okay, an all-in bid is going to get you a better acceptance ratio. And then if you fade some stuff out, you fade some stuff out. But what would you bid on all of these to make it happen? So let's go over here. I'm going to custom sort these. Custom sort, and we're going to go by my data has headers and change it to the last tab, which is status date past dues. We're going to do largest to smallest. All right, so now you see we've got the red on top, which is the non-performing, and we have the performing in the bottom. Okay. All right. So now let's look at these. So the property values, LTV, purchase UPB, original loan amount, current UPB. So let's do this here. And this one's like 1,200 days past due. This first one up here. 1272. It's in New Jersey, Gloucester Township, Staten Island. Those are two of the longest ones. Okay, that's not a problem. Okay. So let's do this though. Let's look at, since we have the current UPB. Yes, and this is going to be small amounts. All right. So let's insert this here. We're going to say equity amount or equity dollars of equity. And we're going to insert a column because that's going to affect your stuff. If they're underwater, you're going to offer differently than if there's equity. Okay, if there's equity on these, it's going to be a pretty simple thing to go across there. And we're going to say percentage of equity. All right, so this is really simple. All we're going to do is just do for the formula is go over to what they gave us the value. Property value, don't know the date for that. So that could be high or low, but that's all they're providing. We'll do that in due diligence. And, you know, if the bids comes in below, we'll fade our bid. Okay. So the property value minus the current UPB. Okay. And so then what we're going to do is take that number, whatever the equity is, and divide that by the full value. And you're going to change that from a solid number just to a percentage. All right. So then you're going to go over here and hit Control C. And you should be able to copy that all the way down. All right. All the way. So now we've got our numbers. They've all got equity. They've all got a sizable amount of equity. All right. All right. So they've all got equity. So if we look at the red here. Oops, we want these to be black going forward. Let's change these down here. We're changing the font from red to black on the ones that are basically performing. Okay. So if we look at these, the non-performing stuff, 14% equity, 34% equity, 91% equity. I mean, there's a lot that have like 90% equity. They're low balance stuff, right? Okay. So when they have a bunch like that, so equity, you're probably going to need to be at 80%. Yeah, see equity dollars? Huge amount of equity on this stuff. All right, so let's just do this. So let's go in here. Now, the non-performing side, we'll get to that later on with a little bit of difference with New York and New Jersey and stuff like that. But if they're non-performing, we'd offer less. Let's see, 80% of the UP. Let's just do 80% of UPB. So that's going to be really current UPB times 0.8. That's a dollar amount. We're going to copy that number all the way down. Change that from black to red. Okay. Now we have the P&I payment on here, right? So let's insert another column in here. Let's say P&I times 12 is equal to, let's go over to the P&I payment, where we have that at, P&I times 12. We're going to copy that formula all the way down again. We're going to change these down here that are in the positive to black again. So to be in red. Red stands for negative. Black is for positive. Okay, so we're not figuring it out. Okay, so now what's great to do this is you can see some of these. So we can get these bars back on track. Now, these interest rates are a little bit all over the board. That's the nice thing about having the stuff here. Where were the interest rates on these things? These were at like anywhere. Yeah, some of them are high and some are low. So if we look at the interest rate tab, it's anywhere from 2.75 all the way up to 14%. Okay. And if we look at the weighted average, okay, weighted average coupon rate, the whack attack, right? That comes to basically it's 7.82. Some are higher, some are lower. But that's what weighted average coupon WAC stands for. So some are higher rates, some are lower. You're going to adjust this to get. So if you're making an all-in offer, you would change things up. So okay, so you get P9 times 12. All right. So the first thing to look at is, okay, take your 12 months of cash flow to get the bar back on track divided by what you pay. Does it make sense? Okay. So remember, 80% of UPB, that's kind of what our technical purchase price, because these all have equity, right? Now, some are low balance, and we're going to adjust that number down to make sense because you have to foreclose on the non-performing side. It's going to take some cost to do that, okay? So let's just go here, though, and let's do this. Let's do our, we'll just say, I would say mod, or let's just say if you haven't paid on time for 12 months, let's just say TPP ROI, okay? Or actually, it's because this is a mixture thing. So we're going to say, if we get these 29 to start paying 12 months on time, divide that by what we paid for it, the 80% of UP, that should give us a rough idea. Same thing on the performing stuff. They continue to pay on time for 12 months. Divide that by 80% of the unpaid balance. What's the yield on that? So it's a pretty simple calculation. So we'll put TPP for that TPP / PN for performing note ROI. Okay. So that is just going to be is equal to our P&I times 12, divide that by our 80% of UPB, which is our purchase price, technically, okay? And we're going to make sure that's a percentage, and we're going to copy this number all the way down we go, okay? Same thing, Control V. We're going to change these last numbers here to black. Okay, so now you see on here, some of the numbers are all across the board. Like if they, like some of these lower bounces, like I'll give you an example. Like this one, the 80% of equity, they only owe $2,900. So yeah, if you paid 80 cents, that's 2,300. Of course, their P&I payments 2 something a month. Well, yeah, it's going to be a pretty good deal. I wouldn't go back and offer 80% as low balance just because it just doesn't make any sense, right? All right. Same thing down here on some of these performing stuff where it's low balance stuff. I'm not going to offer on the low balance side of things because it just doesn't, it does. If you start looking, okay, let me rephrase it. So if we go back here to the performing stuff, okay, performing stuff, you really need to be at 80 cents on the dollar. Now the performing stuff, if you look at this, if we offered 80% of UPB, okay, so let's go over here and just add, so we'll just say total UPB performing, total UPB NPN, okay? I went and added a different tab to it so we can look at these. So if we go to these 23, let's do current UPB. So on these 23, the average is 68,159. It's basically 1567,654. 1567,654. I think that was it. So 1.567 million 654. Okay, yeah, that's a dollar amount on that. Say we're taking it all. Okay. Now, if we go back here to the total UPB on the spreadsheet again, whoops, that was a different tab. That's actually, sorry, I said it in the wrong one. That's actually the non-performing. 1,567,654 is the performing. Nope, I had it right. Sorry, guys. I had it right. That's right in the right tab for the non-performing. Okay, so we go to the performing side. The UPB on the performing side is 1.554854. So $1.5 million as well. Okay. All right. So if we look at, let's do this. Let's say P&I times 12 for the performing. Basically, we're going to take the 12 months of the performing stuff that comes in. So P&I times 12. I'm going to add that number up. So that number comes to, it averages $5,038 in 12 months for each one. So it averages about just under about $450. or it's 246,882, 246,882 coming in cash flow. The stuff with the non-performing stuff would be, if you get the bar to come back to the table, would be 168,096, 168,096. And that's the P&I 12 of the non-performing stuff. Okay. Performing 80%. All right. So it's pretty easy to run a number off of this. Like if the performance, if you bought it at 80 cents on the dollar, what would you get? So if you take your cash flow, the 246,882, and divide that by your 1.554 million on the performing stuff, that's about a 15.8 yield. Okay. 16% if you round it up. Actually, let's go down 2 columns. So 15.88. That's before servicing costs. Okay. Performing, it's rock and roll. Okay. And that would be, what would you say, 49 performing notes? Yeah, it's 49 notes. Okay. If you could get the bar back on track for the non-performing stuff, same thing. If you got them just making their 12 months of payments. So this is going to be equal to our 12 months of cash flow. All right. Divided by the 80% of the UPB. That comes to a 10.7%. Yeah, it's just under 11. 10.72%. That's not considering, let's do this, insert one more. That's 49 notes. And the non-performing is 23. Okay. Now, obviously, that yield's going to go down some with servicing costs, but it could be. So here's the thing: if you could get the borrowers back on track, let's do this another thing. So let's go P&I times 16 for the NPN. So you got 12 months, 16 months. So basically, we add this by a third. So it's equal to the 165 times 1.33, right? Is that right? If you get a third, if you get 4, yeah, 1.33, 1.33. So they pay their 12 months plus you have them bring 4 months, which is a third of the year. That's why you put 1.33. So that now bumps it to 223,576, okay, which is equal to now. That bumps it up to about a 14.26%. Let me blow this up a little bit for you that are watching. Okay. So you see the total UPB on the 49 notes, if we bought at 80% of UPB, is 1.554. The cash flow on those performing notes is 246,882. So basically, you step into about a 15.88% if you bought those at 80 cents on the dollar. Not bad. Performing notes. There is let's go back here. We didn't do the values of these. Okay, so let's look at what they say value-wise is. Now, obviously, value-wise, this is the non-performing stuff. It's 5,718, 705, 5,718. It's 5,718, 705. That's the total value of, let's say property value, they say the 23. If we look at the 23 non-performers, if we look at the 49, the value of the 49, 99589. 904. 9 million, is that right? 9,589,804. I got $100 more in there. Okay, so what we're going to say is this is the fair market value. That's the NPN, fair market value of the performing. Okay. So if you bought this at 80 cents on the dollar, let's insert a comma here. %80 of UPB, and your LTV, you're buying this at, if you want 80% of UPB, it's equal to the 1.554 divided by the performing value. So you're basically buying the performing stuff at 16 cents on the dollar. Okay. All right. Same thing. If we do this is equal to the 1.567, which is the 23 non-performing, divide that by the 5.7 million. You're buying at 27% of value. Okay. All right. Weighted. Number, no, wait, let's do this. It's equal to, just add these two together real fast. Divided by basically you're buying it for just like 3.1 million divided by 15, right? So you're basically buying at a weighted average of 20 cents of value. That's a pretty secure position to be in. Can we agree that, ladies and gentlemen? Yeah, 20 cents a dollar, you're controlling, you're in the first lien position on a 20, yeah, a $14 million, $15 million thing, you're picking basically 3.1. Okay. That's not a bad day, right, everybody? You know, if you got 16%, that's great. You know, now let's look at what's the weighted aspect of this. So let's do this the same thing again. So let's do over here. It's a percentage FMV combined. Both. And let's look what your cash flow is if you just paid for this. So cash flow, both. So once again, we're going to take the same formula. So if we take our cash flows over here, let's just say is equal to that plus change the formula up. We're going to add the cash flows together, and then we're going to divide that plus what we paid for, right? So together, yeah, it drops it down to about a 13% cash and cash return. 13.3 basically. Now, if we got all the bars back on track, let's take that and look at that number. What would it be at both? So is equal to the 242 on the performing. That's normal. But let's do, if we got them back to the 16, which is the 223. Divide that once again by that plus that. So if you get them performing, it would bump it up to roughly a 15% yield. 15.07. That's not including servicing costs on those 72. So that would be your gross stuff. That's if you get them back on track, pre-legal, all that kind of stuff. All right. So now, what if you don't? Now, if you're just buying the performing stuff, okay, it's a 15.88% yield based on D4 divided by, yeah, so basically cash flow by what your 80% of PPP is, right? Yeah, perfect. Fair market value of the non-performing, fair market value of the performing stuff. Not bad. So there's where you come in. Your offer at 3.1, 3.2. So if we look at this, so total is equal to that plus that. So at 3.122, that'd be your total for 72. And your total cash flow is 414. If you get the two, if you get the bars, just start paying on time again. Now, some of these are low balances. You're probably going to be better off getting paid off on stuff like that. And this is all legit. Now, if you go back and look at the spreadsheet here, there's some stuff that would probably, now if you could cherry pick it, it wouldn't make sense for you to do that. So we're going to label this. Okay, let's see these labels. Label this buying all 72. If you have to do an all in, total 3.1 million, you offer 3.1 million at 80 cents on the dollar, and you're going to yield somewhere between well, what if you don't? Well, no, your ROI would go higher if you had to foreclose because you're buying them cheaper. Okay. So, but that's just a quick, this would probably be the highest I would go. I wouldn't go above 80%. And non-performing, I would probably go down a little bit less. But there's equity. So that's the thing you got to look at is if there's a ton of equity above these, obviously. Okay. It's valued at 14 million. If you're buying it at 3, that's like I said, 20% of the market value. Now, are you going to end up with a property? No, on a bunch of, but let's go back to the raw data here. Okay. Now that we've got that information, let's look at the non-performing stuff here. Okay. So let's look at, that's the equity amount, equity percentage. And if we start looking at these dollar amounts, so let's change this up a little bit. Now, this performing stuff, 80 cents of the dollar, they're probably not going to budge much from it at all. Okay. They only owe, like on this one, they only owe $3,200. I'm sorry. They only owe $4,000 going at 80 cents of the dollar, 32. What kind of yield is that going to get you? Yeah, you're going to get paid off in a year based on the payments, 322 a month. So you would probably fade that down maybe a little bit. Something, look at that stuff. Some of that stuff's pretty good. All these legacy first liens, most of them have lower balances. Okay. Yeah, you can make it, what's this, 47, they only owe, yeah, like this one, you're not going to offer, yeah, see, this is one, it says 398% return. Yeah, they only owe 1,100 of 90, so they're going to pay that off in basically, their monthly payment's 394, so they're going to pay that off in 5 months. You're not going to get a full year, so you don't worry about that, okay? But this is where it's, okay, if you could cherry pick these, it might make sense for you just to get rid of the smaller balances. Okay. If we were normally going to cherry pick versus buying the whole thing, let's go that route. Okay. So let's look at the balances. All right, so P&I, we get rid of a low balance stuff. Line all 72. Let's do this one more. So raw data, full tape. So what I like to do before I start messing around with it, let's go over here, copy everything on this tab, and let's open up another one. Control V. All right, so we got everything transferred over. Dollar amount, formulas all look good, right? P&I, yep. All right, so let's make these a little bit bolder and make it a little bit bigger. All right, so this is going to be, let's drag this. There we go. And we'll just say cherry picking. Okay, so now we got our cherry picking aspect. Now we can slice and dice if I'm looking for something smaller. Okay, so first thing we usually do with cherry picking, we still got all the same numbers in here. I don't want to buy non-performing in New York, New Jersey, right, ladies and gentlemen? Okay. So the states I'm going to get rid of, first and foremost, let's get rid of these New York, New Jersey ones. Let's look at Oregon. Let's look at California. I know some California folks. Let's just see if so you can see, yeah. So one's in Sacramento performing, Visalia, California, Sweet Home, Oregon. I really don't want to own those properties. Okay. So we're just going to delete these off. These are not properties I want in states I do not like. Okay. All right. So then we've got rid of those. Let's look at what else. So also, Alabama, let's look at this, see here, Alabama stuff. Because if Alabama is non-performing, it's got a 1-year redemption period. It's performing. We'll leave that be. Okay. All right. So Florida, Georgia. This is a single family home. It's not a bad looking house. We'll leave that in there for the time being. What's the balance on that non-performer? So they only owe, on this one, they only owe 29,000. The value on this is like 350. It might be, if you can get it at a cheap enough price, great, cheap enough. Let's go from there. Okay. Muskegon, Toledo, Windsor, Hartsville, Grand Prairie, Texas, Muskegon, Rhineland, Missouri, Charlotte. Okay, so these aren't too bad. Pensacola, Florida, okay, Georgia. All right, I would buy all those non-performing areas for pretty much more. Okay, we get into the performing stuff. This is all performing stuff. I would probably buy it all. Chicago, I really don't like that. I'd probably get rid of Chicago just because if they ever did go. So let's look at this here real fast. Hang on here. View, freeze panes, so we can see everything. All right, so Chicago. Valued at 267. What do they owe? They only owe 18 and some change. They're performing, leave it in there. Might as well leave it in there. It's perform. Mission, Texas, Rockmart, Georgia, Florida. They're all performing. So the thing you got to worry about if you're buying stuff is obviously in Georgia, you got to have that state licensing website, either mortgage broker or licensed with somebody. This one on Georgia, you could get away whether you're going to use your IRA because its value, property value is only 65. Loan amount was 52. They only owe 7,000. You could fund that in an IRA and it'd be exempt. So you're okay. Fund that one with your IRA or fund it with a company and then transfer to your IRA. You're sitting okay there. Okay, so now Miami. Yeah, all right. So let's go over here and look at these low balances. Our current UPB. Let's get rid of some of these small ones. They're just going to be a waste of time. All right. So 1,000. I mean, you could offer I would go and offer like 50 cents on the dollar maybe for those. They're going to be a pain in the ass for a little bit, but maybe it does make sense. So like we start getting up into, yeah, these non-performing stuff. So anything that's under 10,000, let's see what, so yeah, so you got some performing and non-performing. 80% of UPB. Toledo, Ohio. Okay. Equity, plenty of equity on these. 80% the equity in these. So these, let's change these. Yeah, it's too at 820 for the transfer docs, you're going to lose a couple $100. It's not going to be 507. Yeah. I'm just looking at the numbers on the current UPB. Let's change this to $1. So what I'm doing, I'm just looking at the current UPB versus the P&I from 12. So most all of these. So UPB is only 1,000 on that one. We're going to change this to just 1,026. 7088. This is 3905. So we're the 2442, 3870. So the thing is, I'm wanting to make sure that my payments, like this one over here, is a current UPB of 1488. Well, I'm not going to collect $4,735. So I'm just going to type in 1488. That's what I collect, right? Everything else, though, in the first year, I would collect more. Yeah. So let's adjust our numbers on the performance side a little bit. Not much, but a little bit. Okay. But since we're cherry picking these now, this would make more sense for us to do that now that we've got our making sure 80%. Yeah, on some of these, especially these non-performing side. Let's look at these. Let's change this all here. Okay, so perfect. Okay, so now we have everything. So we have, all right, so we got 80% of the UPB where there is a ton of equity. Equity percentage. So non-performing, we're going to have to change this to 65. Yeah, there we go. So, because look at this. This is what I'm trying to get at. So this one here, they owe 30 grand. They've got a ton of equity. This is that Largo, Florida one. But to offer 23 is too high if foreclosure hasn't started because it's in Florida, right? So this one, we probably need to be closer to 60 cents on the dollar. 70, that gives us a little room. If we foreclose, we can still make some money on that. It's 12. Okay. So it's kind of skinny at that. Same thing with this one here. So we're going to drop this down to 60 cents on the dollar. Okay. And this other one is worth valued at 90. The current UPB is 90, 77, 97, and 77. That gives us 20 grand if we have to foreclose. What state's that in? This is in Michigan. All right, they owe 149. I mean, the value of the property is 149. Okay. So yeah, that's not so bad. We would leave that one be 20 grand potential, get back on track. Yeah, they got 52 grand above. So you can make 20 grand either at the foreclosure, you take it back and you make 70 grand. Okay, great. Yeah. So the one UPB, they've got some equity. So you're buying these, they all have, okay, so like this one here, UPB is 12. They got a ton of it. They're not like 90% equity, so it's worth about 123,000. Sorry. 130, it's 132 if you add those two together. Okay. That doesn't make any sense. Let's change that from 80 cents on the dollar down to 50. Okay. Same thing on this one. We're not going to pay 43. We're not going to pay 35. for 43. So let's jump that down to 60 cents. Same thing. We're not going to pay 25 for 30. Change that to 60 cents. Let's just copy this down, Control C, because these are some lower balances. Yeah, we're just gonna do that for the rest of the way down. Control V, 60 cents on the way down. Some of them was 80 cents. There's a side like 34 grand. You're not going to adjust that in profits between what you paid for it and the legal balance. So there you go. That's a probably better aspect of things, looking at this non-performing stuff. You cherry pick it. You know, depending on the condition it's in. You know, the performing stuff, you leave probably 80 cents a dollar because I got a ton of equity. Okay. Like some of these that we start diving into this non-performing stuff. Obviously, you're still going to set stuff up. So let's do this. We look. The Largo, Florida one is not a bad looking little condo. Just going to do this. We're going to share our screen. There you go. So this is one in Largo, Florida we talked about. They've got a little balance on about 30,000. Worth more than that. This is a photo from a few years back. You know, definitely some pride of ownership. Okay. We go back to our spreadsheet. Let's look at this one. So this one in Largo, it's non-performing. It matures in 2 years, 2.5 years. They only owe 30. See, they're due. They're due for February of 2023. Okay. What's going to be my action? So this would be to either, you know, as I'm saying, it's going to be either to foreclose or we're going to look to mod. Bring some money to the table. You're 2 years behind. As we sit right now, you're 2 years behind. This next one down here, same thing. Less than 2 years, about 18 months, foreclosure mod. This one's June of last year, so that's going to be a foreclosed mod. January of last year, they're 115 days behind, foreclosure mod. If they don't do something, we're starting to get to 120 days. You know, some of these where they're only like, you know, that's another thing. They probably are not going to let us get that. Well, they might get a 60 if they won't get them off their table. Okay. So these, we would probably look at just reinstating because they're less than 120 days. Yeah, when you get 120 under 120 days, that would be the first thing. Hey, you haven't paid in 90 days or less. Let's get you back on track, shall we? Now these others down here are like less than 30 days. You're not going to bid. They're probably just late. So that's the thing. I think on a big chunk of this list, you could get the borrowers back on track or have you pay you off. These three, potentially 5 would be your ones that you're going to be foreclosing on. Potentially 3 to 5 foreclosures. They're at that 120-day mark. But there you go. So that's the thing to look at. They're not the biggest default, but they're getting that now. They're getting past due. They haven't paid since last year, since January this year. You know, that's the thing. Non-performing stuff, they're probably going to still want us to come back looking at that, which I probably should have looked at a little bit earlier. My apology. But if they come back at 80 cents a dollar, okay, 80 cents a dollar. But if you can offer and get it 60 cents, why not? This is why it's important for you to know your marketing and know your numbers on that. So let's look at just some of these quick non-performing ones, especially these foreclosures. This one's in Danielsville, Georgia. So based on photo, if it still looks like it does now, this one is Holman Autry Road. This property, this does not look good. This is for February of this year. Let's go over here to the driveway, see if we can't peek down the street. Probably not. Let's look at 2. Let's go back and look at the overhead view. There you go. That's the house. That's not, I mean, Georgia's a relatively fast foreclosure state. where that one is located at compared to like major cities. So it's north of Athens and northeast of Athens, kind of out in the boonies. Doesn't really excite me too much on that one. All right, so let's go back to your tape. You might just get rid of that one. Let's look at this one in Muskegon, Michigan. And this one doesn't look too bad. Look at this property. Yeah, this is May 2024. That's it. It looks vacant though, doesn't it? Side here. Oh, you get the bird feeder there, so you get a little maybe occupied. You got a tarp over that extension. It's not too big a deal. It's not the roof. Get the covered garden. That's the house next door, I think's backyard. Yeah, it could be a whole lot worse. All right, let's go back here. It's not a bad looking one in Muskegon. There is another one in Muskegon, if I remember correctly. Let's jump down here to this 339 Amity. Oh yeah, I looked at this one earlier. It's not a bad looking. Yeah, see? 339. Get some. Hopefully it's not overgrown. This is from June of last year's photo. Yeah, it's a nice looking property. It's well taken care of. Relatively newer roof. Maybe it is vacant. Maybe it's a little older. That's why I haven't paid. It's not this yellow house. Yeah, I mean, it looks like maybe the bar has passed away. Who knows? Maybe that's why they're late. Okay, but yeah, it's not a bad neighborhood. You know, a little older, some older homes, but hey, that's a pretty good looking little house. Okay, let's go back here to our tape. This one in Grand Prairie. Let's look at this 846 Timberland. This is barely behind. Share. Everybody likes Texas. Grand Prairie's outside of Dallas. And there you go. This is from November of 2023. Oh, pumpkins are out. That's November. I really don't like that different colored brick, but that's a pretty easy fix. It's okay. Yeah. Same brick across the street. So the builder got a discount. Yeah, that's not so bad. The performance, if you can dive in, let's look at, see if there's anything else here. Texas. Let's look at the Florida one. Just for the heck of it. You know, Florida's obviously, it's Pensacola. You got to worry about insurance. You know, they haven't paid in a couple months. It's occupied. Roof is a little older. Yeah. Not so bad. And that's the thing. These properties, look at the next one to it. It's missing it's got a tarp on the roof. That's probably vacant. A little rougher neighborhood, but if we go back to the spreadsheet on this one, we see on this one, this Pensacola one, it's worth 150. It's a 12% interest rate. They bought it for 56. Current UBP is 18. Yeah, I mean, you get it. Somebody's going to pay you on time. They don't want to lose that. Yeah. Borrower on this one. I'm getting notes on the borrower. Yeah, they're only 54 days behind. If they don't, they're going to miss out. I mean, you foreclose or cash for keys. That's what you could do with some of these too. So The Texas ones, there's a few in Texas here. I know everybody always wants. Let's look at the one in San Antonio. San Antonio, Texas. Over here. Share it. Now, this is a performing note, not a non-performer. But so they've got a. So this is from 2016. If we move over here, here's a photo from 2022. Okay, they got a gate. What's the neighborhood look like? And I got a few gates. So maybe there's some wrong, maybe not the nicer part of San Antonio. Let's see what the overhead map looks like. Yeah, that's a rougher part of San Antonio, but still made money. I made money there, definitely on the south side. Okay, no problem. So there you go. If we go back here one last time to our spreadsheet, there's performing stuff. You could get rid of some states. Maybe the Florida. But they're paying. So as long as they're paying on time, and they've got their insurance paid up, not so bad. Let's look at the Houston one last thing here. Control that. Houston, you have to sometimes worry about. So this is, was it? Yeah, it's only like a 1,400 square foot house. And this photo is from February 2022. Okay. It's occupied. They're paying. Not the greatest, but if you can make a nice yield on a performing note, let's go back to that. Yeah. So if you bought the performing stuff, just the performing stuff on most this, it's a pretty good yield. Buying at 80% and getting a 15 yield on performing stuff, why not? Borrow money at 8%. Pay, even pay your servicing costs would be cheaper on that. That's a pretty good 49 notes at that. So let's do this. So let's take 49 notes over here. 49 notes. Let's just say you're getting them at $25 a month servicing. So that's actually $300 a year, right? 25 times 12 is 300. So that is equal to that times that. 49 notes times $300 a year in servicing. So it's $14,700 in costs. So the cash flow on that. So if we figure, so we take equals to our cash flow on the performing is $246.82 minus our $14,700 per year for servicing costs. That's $232 a year. Your net is $232. So take your net and then divide that by your $1,554. That's just under a 14.9%. There you go. But you're buying stuff. Fair market value is worth $5. You're buying it at 30 cents of the dollar. That's a pretty good day. Yeah, 27 cents on the dollar, basically. Is that right? Yep. There you go. So buy 40 notes, get 14.93%. If you borrowed your money at 8% from an investor, you're paying out 124 a year in interest, and you are pocketing 90 grand. No, you're making more than that. Sorry, you're making $108,000 on 49 notes passively for a while. Now, obviously, you go back and look at some smaller numbers, but this is off of that by the full thing. I'd get rid of some of those smaller balances. But there you go, ladies and gentlemen. That's a way to make a six figures career, buying 47, 49 notes of performing or buying some non-performing stuff and getting a pretty good yield on the foreclosure as well. All right. So hopefully you find that valuable. Like I said, guys, if you're listening to this, go on over and click on the link in the description to watch the YouTube video. If you have questions, feel free to type them in me. Shoot me a question. If you want me to dive into an asset with you, I'm glad to do that as well on a deal that you're looking at. We're always here to help you guys. Always want you guys taking the next step in closing deals, making offers, and going from there. All right. So as always, you can book a phone call at talkwithscottcarson.com. That's talkwithscottcarson.com. And we can book a 30-minute phone call. If you're going to go through a deal or something, just put a notes in there what you want to talk about, breaking down a deal, something like that, or we can jump on the phone and then I can shoot you a Zoom link and we go from there. But go out, take some action, everybody, and we'll see you at the top. Bye, everybody. Hey, real estate investors, this is Scott Carson. I'm known across the country as the note guy, and I've been an active note investor, focused primarily on the niche of non-performing notes, distressed mortgage notes on residential commercial properties for almost 20 years now. My company is WeCloseNotes.com. And I know there's a lot of different things when it comes to the note world. Are you buying performing notes? Are you buying owner finance notes? Are you buying institutional debt like I would focus on? Are you buying first, seconds, contract for deeds? There's a lot of questions. And it can be very confusing about what you can or cannot do. So one of the great things that we've hosted for the last couple of years that we do on just about a regular monthly basis is we host our one-day class called Note Weekend. If you go to noteweekend.com, you can register for a free 3.5-hour class. We'll talk to you and share with you how you find, fund, and flip non-performing notes. And yes, you can buy non-performing notes from banks, hedge funds, and a variety of different hard money lenders out there for your own portfolio. No, you don't have to have millions of dollars to dive into the non-performing note game. We've got students that have bought plenty of deals with 25, 30 grand, getting their ball rolling, using their self-directed IRA, who are tired of dealing with toilets, tenants, trash outs, tired of battling contractors and GCs to get properties rehabbed. We all know the market is changing. And while it may not be like 2008, 9, and 10 again, we do see a lot of distressed debt out there on both the residential and the commercial side. So if you're thinking about diving into the note game, becoming a note investor, a lien lord, as you like to say, versus a landlord, or you just want to figure out what it is about the sexy side of real estate in the note space, well, check it out, noteweekend.com. Doesn't cost you anything. We host it live, usually the first or second Saturday of each month. You can go today, register at the website, noteweekend.com, register for the next live class we host. You'll get sent a replay of the previous class so you can start learning about the note business today. No questions asked, no credit card needed. This is a great way for you to dip your toes in the water and see if it's warm, because I guarantee going through our one-day class, you want to dive into the deep end and become a note investor. So check it out, noteweekend.com. You can also go to our website, WeCloseNotes.com. Check out our podcast. Check out our #1 YouTube channel. We are here to help support you. Whether you're an experienced investor or you're brand new to investing, Note Weekend is a great place for you to get the ball rolling. People often say we cover more in our 3-hour class than most people cover in their 3-day class. So check it out. Love to have you be part of our Note family. But get signed up today at noteweekend.com. Thanks and have a great day. Hey, real estate investors, this is Scott Carson. I'm known across the country as the Note Guy. For the past 20 years, I've been buying distressed assets, primarily non-performing notes on residential commercial properties. And if you've ever wanted to learn how to dive in to start buying non-performing notes from banks, hedge funds, or other investors like yourself, then there's no greater place than to get the nuts and bolts, the A to Z, the 1 through 99 place to get started is our virtual note buying workshop. We've been teaching this class since 2010 on how to find, fund, flip non-performing notes, how to get banks to call you with deals that you can cherry pick. And no, you don't need millions. No, you don't need a lot of experience to start looking at non-performing notes. We get lists of notes from banks, hedge funds on a regular basis, not 1 or 2 or 3 or 4, but hundreds of deals that we can evaluate and cherry pick. Whether we're looking for performing notes or non-performing notes that we can get reperforming, or non-performing notes you can foreclose and take back, whatever your niche or whatever you would like to focus on, we can help make it happen at the virtual note buying workshop. It's a 3-day class. Our next one is April 18th to the 20th. It's actually online live via Zoom. You get signed up by going to notebuyingfordummies.com. That's notebuyingfordummies.com. Day 1 is all about how to find these assets. How do you find asset managers? How do you find lists of people to reach out to that you don't have to spend thousands of dollars on postcards or letters that you waste money on? We don't do that. Day 2 is all about raising capital and marketing and how to create a business that feeds itself, that you can do part-time, 10 hours a week, 5 hours a week, depending on what your focus is. We'll show you a game plan to achieve deal flow coming in on autopilot versus you having to send a ton of money. And also, we'll show you how to raise capital like nobody else does. And then day 3 is all about the flip. How do we structure deals? How do we evaluate a tape to find the deals from the duds? All right. We'll show you what vendors to use. We'll give you a 200+ page manual, contracts, sample forms, all the stuff that you need to be a lean, mean note buying machine when you get wrapped up. Now, yes, this is live April 18th or the 20th online via Zoom. Get signed up today. We'll send you the replays of the previous online workshop so you can start learning, start evaluating material, and get rock and rolling. And if for some reason you don't like our class, we have 100% money back guarantee involved with it. If at the end of the first day you don't like what we talk about, you don't think it's impactful, just let me know. We'll refund back your tuition, no questions asked. We don't want your money. We want you to become a note buyer. We want you to become a lien lord. All right. Like I said, if you're tired of dealing with toilets, tanks, and trash outs, you don't want to deal with renters, then becoming a note investor is the path for you. Everybody evolves into a note investor at some point, but there are plenty of opportunities out there. There are millions of non-performing notes that you can cherry pick. No, it's not all junk. It can be small value all the way up to $1 million homes or $1 million apartments for you. So much opportunity is taking place right now in the chaotic market that we see. And who's going to come out on top? Note investors will. So take the time, get signed up today, April 18th to 20th. Go to notebuyingfordummies.com or go to our website, weclosenotes.com, and sign up for the virtual workshop there. As always, get signed up today. We run discounts all the time. The cost of tuition is you plus your partner or spouse. So get signed up today at notebuyingfordummies.com, and we'll see you at the top.